equity made.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, where we will help you learn to invest in 15 to 20 minutes or less. We break down the world of investing from beginning to dividends so that you can hopefully make some returns. My name's Bryce, and as always, again, joined in the same room by my equity buddy, Alec Renahan. How are you going, bro?
I'm very good, Bryce. I'm very excited for this episode.
Same.
Yeah,
Truths will be revealed.
Yeah, we're going to pull back the curtain and examine each other's portfolio.
Yeah, so I'm not sure if I'll be revealing everything about my portfolio. I might be doing a dummy here.
Yeah. I'm backing you to have 100% cash.
Very close to it.
Yeah.
Which is why I want to do this. So let's go back to the beginning, Ren. Last episode we spoke about portfolio construction.
Yes.
What it is, what's a portfolio to begin with, and then 3 key things that we considered important when constructing a portfolio.
So let's quickly recap.
Yep.
Your portfolio is all of your investments or where you've allocated your wealth. So whether that's the house you own, the shares that you own, the bonds, the term deposit that you've put some money away into, all of that put together is your portfolio.
Yep. Not just stocks.
Not just stocks.
Yes.
And so the question that you need to ask as an investor is, beyond just the stock market, how have I constructed my whole portfolio? And then coming from that, what are the risks and what are the opportunities that have come out of that? And will it be getting me towards whatever my goal is?
Yeah. There's no point just treading water, putting money into this, money into that, hoping for the best, because you're A, wasting time, B, probably wasting a lot of money, and C, probably not learning as much as you could be along the way.
And you might be picking up pennies in front of a steamroller.
Yeah.
Haven't heard that saying before?
Yeah.
Oh, okay.
Talk me through it.
So, as I said in the last episode, I'm rereading Black Swan. And
Rereading?
Yeah.
Interesting.
And that's that's a phrase that he uses where he talks about investors who don't understand the sort of the nature of a black swan and what these catastrophic events can do.
Yeah.
So they're just mindlessly picking up pennies in front of a steamroller.
Really?
They're
about
getting
to get slammed.
Yeah.
Interesting.
So
we need to avoid that.
But also read the book. It's really good.
Yeah, I should read it. All right. So I guess to avoid picking up pennies in front of a steamroller, what were the 3 things that we considered important when constructing a portfolio?
So the first one is have a goal.
Yep.
Know why you're investing and what you're investing for.
Yep.
That's important because that will set your time horizon, and then the next 2 things, which are your level of risk.
Yes.
So, obviously if your goal in investing is because you're about to retire, your level of risk is going to be far lower than someone our age who wants to build long-term wealth.
Yep.
And then the third thing that flows from both your goals and then the level of risk that's acceptable is your asset allocation.
Yeah.
So that's the nuts and bolts of how you construct a portfolio and where you allocate money to achieve the goal, I guess.
Absolutely. So let's discuss.
Here we go.
So we both generally spoke about our goals in the last episode.
Yeah, well, let's recap because some people might not have listened to the last one. Although everyone should.
Yes, definitely go back and listen, because I feel like you need to have listened to what we were talking about prior to this episode to really get the most out of this one.
Yes.
So, Ren, what's your long-term goal?
So my goal is to have the financial freedom to be able to make the life decisions that I want. And so what I mean by that is I don't want to be stuck in a job just because I need the income.
Yep.
I want enough money stored away and enough income coming from those investments that if I want to quit my job or do whatever, go back and do my study, I have the flexibility to do that.
Not a bad goal.
Yeah.
Pretty good. Pretty motivating goal.
Yeah. Well, that's why I do it. That's why I'm not spending all the money that I'm earning at the moment.
And do you generally have a thought at what age you would hope that to be the case?
Well, I mean, tomorrow would be nice.
Yes.
But realistically, I think we always talk about long-term investing, and I would say it's, 10, 15 years down the track that I would be in that position.
Yeah, especially as we get older and start earning more money, like the pace at which we'll be able to achieve the goal will accelerate.
Yeah.
So yeah,
and,
not bad.
Yeah, if it's something that in 5 years I want to do more study, I'll be in a better position to do that. But the way that I'm thinking is sort of around when I'm 40, I'd love to just be able to retire and just do things that interest me. Yeah.
Okay, so I've got a question for that we'll come back to. I guess my goal is a bit more specific than that. Yes, I agree with you. That's the ultimate goal for me as well. But I'm thinking a bit shorter term. Yes, I want long-term growth. And I also want to have a portfolio that's generating income compound effect at this age and that I can use later on in life. But I also want to develop a portfolio in the shorter term that it's defensive, not only in the point of view of protecting my capital, but defensive in the fact that it's going to make me money when the stock market decides to turn, because we all know it's going to happen.
Yeah, so you keep saying.
And then in terms of products, I've had to think about it. I want to be able to consistently invest a recurring amount so that I can take advantage of dollar cost averaging, which I think is a very important aspect of investing, and do that at a very low cost, both in terms of management fees and brokerage fees. So I've got something in mind that I can access that with that we'll talk about later. So that's my goal.
Nice.
Quite specific. So I guess first question is A, does your portfolio currently reflect your long-term goal? And B, if not, what sort of, let's talk about risk, what sort of level of risk is your sort of portfolio at the moment based on, what your goal is at the end of when you're 40? Yeah.
Realistically, it'll be further than 40. But,
yeah.
So my portfolio at the moment, so my risk appetite is pretty high.
Yep.
If I lost 50% of my wealth at my age, at this point in life, it wouldn't be the end of the world. And I'm willing to take on that level of risk to try and accelerate, the compounding effects further down the line. So I have positioned my portfolio pretty aggressively.
Okay.
And what that mainly means is a lot of exposure to equity markets, both in Australia, but more and more overseas.
Okay, and so when you say exposure to equity markets, are you saying through ETFs or direct stocks? So
let's answer the asset allocation question, and then that will answer that as well. So my portfolio, as it currently stands, is rounded 20% in ETFs, market ETFs, like equity ETFs, 40% in stock picks, so individual stocks of companies that I've chosen, 10% in bonds or hybrids, 5% in gold, 20% in cash at the moment, and then 5% in alternatives.
Does that add up to 100?
Yeah, I'm pretty sure I did the maths before. Yeah.
Okay, so you've actually got quite a diversified portfolio.
Yeah, so 60% is exposed to equity markets.
Yep.
And that's because I want to see a lot of growth.
Okay.
The 20% in cash, if we weren't 10, 11 years into the cycle, some of that would also be in ETFs as well.
Okay.
Yeah.
So talk me through your gold acquisition. Why?
Gold has traditionally been a counter-cyclical asset, and what that means is that when markets go down, investors worry and take their money out of the market and put it into gold as a safe haven. So I've just got a little bit of gold in my portfolio in case things go south, like you keep saying they will. I would then sell the gold. Ideally, the correlation holds and gold goes up.
Yep.
Sell it at a higher price and then put that into the market, into equities when they're super cheap because the market's just crashed.
Cool.
In theory, that's what's meant to happen.
And how have you done that?
Through a gold ETF.
Okay, so you haven't gone out and bought a gold bullion.
No.
Stored it in your back pocket.
Although, I might get a gold watch or something.
So, are you happy with your portfolio construction at the moment? Do you think it is putting you on the right path?
Yeah, I think so. The 5% that I've got sort of for like alternatives was in the crypto craze.
Yeah.
Dabbling in that, which
Yeah.
I wasn't happy with.
Yeah.
But aside from that, I'm pretty happy. 40% in stocks that I've picked is maybe a little bit high because, you know, I'm not a stock picker.
Not
but
Warren Buffett. You gotta learn, man.
yeah, that's it. Yeah, and that's the other thing. It's all a learning experience. So yeah, pretty happy. Can't complain.
Nice. And how do you allocate cash into the portfolio? Do you have a recurring investment into anything at the moment, or do you just have a lump sum that when it hits a certain amount you'll buy an asset class that you're interested in, or how does that work for you?
So I put money from my paycheck into my trading account every month,
Yeah.
and then it will sit in cash, and then when something takes my fancy, I'll pull the trigger. No predefined rules around X amount of cash, then put it in Y or anything like that.
So when you say your cash position was, I don't know what it was, 20% or something, is
yeah.
that 20% is actually just sitting in your trading account waiting to be deployed, or you've got an investing, you've got a savings account as well?
So
or?
that cash is, some of it's in in my investing account, but most of it's in like a rainy day fund that I have.
Right.
Yeah, which is like you put a certain amount of money in it every month, and it gets a bonus interest rate.
Right. Okay. And do you have anything defensive in there that can make you money if something turns sour?
Well, so the gold.
Yes, other than gold.
And then hopefully the bonds don't fall too much.
Yeah.
So that should be pretty smooth sailing. Should be.
Yeah.
We'll see. And then obviously cash is king if things go south.
Yeah. Right.
Yeah.
So we've identified that you're relatively high risk appetite, not a risk taker as such, but like your appetite for risk is there, and your portfolio is constructed to somewhat reflect that. Talking about your long-term goal though, which was to be generating income at a certain age that will allow you to de-stress about having to earn income in a job that you probably don't want to be doing. Is anything in your portfolio at the moment generating income?
So Australian stocks generally do from dividends.
Yeah.
And then the bonds or the hybrids that I have will pay me quarterly.
Uh-huh.
But my thinking more along those lines is, if I got to a point, if I was lucky enough to earn enough money that I could relax and, you know, take a lower paying job or whatever and earn some income, I would shift the equities part of my portfolio more towards bonds and stuff like that, which are more defensive, but pay more regular income as well.
Yeah.
Yeah.
Like my dad.
Is that what he's doing?
Yeah, they're very heavy in bonds.
Yeah, and I mean, he would be close to retirement, so that makes sense to do that. You don't want to be, however old your dad is.
No comment.
Yeah, you don't want to be 40 like your dad, about to retire and have the next JFC happen.
Yeah,
because you don't have the time horizon to get it back.
Yeah,
you're just stuffed.
You're stuffed. That would be such an anxious and fearful time to be investing, I think.
Yeah, and that's what heaps of people had during the GFC.
Yeah,
they
just screwed.
Yeah,
screwed.
And you know, then the double whammy if you're an American and all of your wealth was tied up in your property, your house, and then also your 401k, like retirement account, like your super equivalent.
Done.
All of a sudden, the housing market collapsed and equity markets collapsed.
Back to square one.
Yeah. So, I mean, it is a pretty scary thing to think about. And that's why when we talk about setting goals, what that gives you is a time horizon, and then that needs to inform your decisions. Because, like, once you lose it, if you don't have enough time for markets to recover, then you're gone.
You're tough, yeah. And look, they've had 10 years to recover, which they probably haven't. We're probably about to see another one happen again.
Well, no. If you held through the GFC, you were golden within like 18 months.
Yeah, exactly. So
yeah.
I guess we're at record highs for everything.
Yeah. We're well beyond GFC
well.
levels. Yeah. And that's probably a lesson outside of portfolio construction. That is, if you aren't set up in cash and the market collapses, you just have to ride it out. Yeah. The worst thing you can do is sell at the bottom. Yeah.
The worst thing you can do. All right, Ren, so that's your portfolio.
Yeah, here we go. The main event, what all the listeners have been waiting for.
Mine's nowhere near as interesting as yours.
I'll be the judge of that.
So everybody knows who's been listening to the show that I think something's coming on the horizon, and I said to myself in 2009 when the GFC came that I want to be in a position to take the most benefit and opportunity when it comes. So that to me means being in cash. Yes, I'm forfeiting some of the rises that we're seeing at the moment, and I fully understand that. I'm actually at an interesting point now where I'm starting to think, like, should I be more heavily invested in something other than cash?
Don't second guess yourself.
No, I'm sticking strong.
That's exactly what I did with crypto. I was the biggest doubter for so long and then folded, like, right at the top.
Yeah. So I'm sticking strong. So I'm just looking at it now, and I am 25% equity, 75% cash.
Really?
Yeah.
And that's it?
That's it.
So no other, property, commodities, bonds, anything like that?
No.
Okay.
But it makes me think, though, and I would like to get your feedback on this, with my defensive outlook and my pessimistic outlook, I think it's something that I should be looking at in terms of, should I be in gold or silver, or should I be looking at, for example, some notes or hybrids or bonds that, as you said, have that defensive nature, because I've got this lump of cash sitting here that, I want to have some of that available to take the opportunity when it comes, but, could it be going to better use now and also setting myself up for if something were to happen that, those assets are going to perform. So 75% cash. What should I do?
Well, I don't want to be giving you advice. I don't want to be the one responsible for that.
No, I'm not going to listen to you, guys. I'm just interested.
Well, I guess the question is, so you say you've got 75% cash, but what's that doing at the moment? Is that earning any interest?
Yeah, so it's sitting in a high interest account. And then I've also got a recurring investment going into Raise.
Okay.
Just so that I'm exposed to a broad array of equities.
Yep.
And then I've got direct exposure to 4 individual stocks. And then of my total equity exposure, about 20% of that is in a listed investment company. So that's a bit diversified. So, yeah, at the moment, I guess I'm getting my dollar cost averaging through Raise. That's just because Raise is easy for me. It's not my main form of investment either. It's just a supplementary thing that I've got going on. But otherwise, cash is just sitting in a high interest account.
Yeah. So, I mean, if your cash is earning 3% per annum,
yep,
and there's a bond or a hybrid out there that will get you more than 3% per annum, and it's pretty safe, then that's definitely something to consider.
Uh-huh.
The issue would be, so I just got in Macquarie's hybrid, and it'll pay me more than 3% per annum, but if something happens to Macquarie, or if something happens to the Australian banking sector more generally, or the Australian market more generally, the face value of that will decline.
Yeah.
And so then you're really stuck. You can either sell it at a capital loss, or you just have to hold it and keep getting the coupon payments every quarter, and when Macquarie redeem it, they'll redeem it at face value.
Yeah, so they are liquid then, are they? You can cash out whenever you want, but you just cop a loss. I guess because they're on the stock market,
They're
that's why.
exchange
Yeah,
traded.
okay.
Yeah.
But some bonds you can't. You're locked in for that period of time.
Yeah. So most of the bond market's like 4 times as big as the equity market, and most of that is not traded on exchanges. It's over the counter.
So I guess that's something that I need to consider, liquidity. If I am to deploy some of this cash, it would want to be in something that I will then be able to sell quickly enough that if something happens and I want to access that cash and put it elsewhere, that's something to consider.
And so that's, what we were saying about gold. That's why gold has historically been good for that.
Yeah.
Because it's liquid and you can generally sell it at a higher value. Like, you'll make money if the market turns, and then you can get into something cheap. But gold and silver have been getting smashed.
Yeah, it's all over the shop.
Yeah, I don't know. I wouldn't want to recommend that either.
No. So gold's a possibility. The other thing I'm thinking about is an off-market Vanguard. I've got one, but they're very specific. So you can either go like international shares excluding Australia, or so this is ETFs I'm talking about, but off-market, not on-market.
So not ETFs.
Well, yeah, so not ETFs, so a fund, I guess.
Yeah,
the reason I like these is because, as I was saying to you, you can BPay into them and at a minimum of $100.
Okay.
So you don't have to buy on-market pay brokerage and minimum of $500. So you can set up that recurring payment.
Yeah. Now, are they index funds or are they managed funds?
They're index funds.
Yeah. So they just track.
Yeah,
basket of
whatever.
stocks.
Yeah, and then rebalance and all that sort of stuff.
Yeah.
So that's another possibility. It's quite a high minimum to buy into those though, so that would take up a fair bit of chunk of cash. So it's a minimum of $5,000 to buy into that.
Okay.
And again, the liquidity on that, reasonably good. But it's not like selling stocks, because you have to sell minimums at a chunk, and if you don't close your account, you have to keep a minimum amount in there as well,
right.
which sort of makes it a bit difficult.
So what's the benefit?
To me, the benefit of that, and I was actually talking about... Sorry.
Are you going to...
Yeah.
Yes.
To me, the benefit of going off market, and I was actually talking to one of our listeners, Pippa, today, so if you're listening, we had this discussion this morning. The benefit for me really is the fact that I can continuously invest in it at a low cost without paying huge brokerage for $100 or more. BPay, bang, 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 week on week. So that I can just keep getting in there rather than buying lump sums through the stock market.
Yeah, okay.
That's really it.
Yeah. I mean, there's no bad decisions really. Yeah.
Otherwise, like, I'm totally not interested at the moment in buying stocks. I think it seems a bit contradictory to me to say something's going to happen and then buy stocks at these record highs. So I don't know if you would agree or not, but I know could be a really silly decision because, you know, historically the stock market's always going to go up. Well, not always, but it generally does. So buying now, I might take a hit, but over the long run, probably going to be higher. But like, to me, it's sort of like, do I wait for the opportunity when they're a lot lower? I don't know.
Yeah. It's a tough one because it makes sense, but if you wait 3 years, like...
True. How long do I wait? That's kind of starting to freak me out now. It's actually, I got to stick to the 15th of September though. I can't do anything. I can't do anything before then because I predicted 15th of September is when we're going to see something.
Yeah.
So like, I've got to back myself in. I've got to back myself to at least the end of the year. I think.
We should explain that to our listeners. So if you've joined us halfway through the year, in the first episode of this year, Bryce predicted 15th of September 2018 would be when the market corrects. Yeah. Which also Wayne Swan pointed out happened to be the day that Lehman Brothers collapsed. Yeah. Which I don't think you realised when you made that prediction. So it would be very fortuitous if exactly 10 years to the day. Yeah, well, you might, but ASIC might be calling you asking how did you know? Yeah. So anyway, 15th of September, guys. We'll do a special episode on that day.
Yeah, big time. So yeah, I've got to back myself, stick it into the end of the year, and yeah, there's a few things. But look, overall, I think what I want to quickly address is my risk level, very similar to yours, Ren. Obviously not at the moment. I don't think my portfolio necessarily reflects that. I've got sitting here in a lot of cash. I'm not wanting to take a lot of risks for that because I'm waiting for the moment.
Come on, mate. What is this? Is this bloody cash mates or equity mates?
Yeah.
Get it in the
Watch
market.
my cash grow.
Yeah, savings mates.
And asset allocation, like as I said, listed investment companies, and then stocks and cash. So look, not as diversified as you, but definitely thinking about these things. And I'm not in any rush to do anything. If opportunities present themselves, then I'm going to be ready to take it. So I think this is something that we should definitely continue talking about as episodes go on as well. It's very interesting and great learning for our listeners. So in the interest of time, we should definitely wrap it up there. Is there any closing statements you would like to present?
No, that's all. I think, I agree. I think it's good that we discuss this. If any listeners want to tell us their
let us know.
We'll feature you on the next portfolio construction episode.
Yeah, absolutely. And if we haven't done so let's leave it there, Ren. And as always, good to chat. And now good to know that the curtains are pulled back and we know everything about our portfolios. So let's leave it there.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.